Here's a shocking truth. Most options traders are paying far more in taxes than they need to, simply because they don't understand the tax rules. I've seen traders lose significant portions of their profits to taxes that could often be minimized with proper planning. Welcome back to Options Guide, where we cover the real-world aspects of trading that most channels ignore. I'm your host, and what we're discussing today could be worth more to your bottom line than any trading strategy. Tax efficiency makes a meaningful difference in how much of your profits you keep, and it compounds over time. Grab a pen and paper because today we're diving into the tax code rules that separate informed traders from everyone else. Basic options tax treatment. Let's start with the fundamentals. The IRS treats options as capital assets, which means profits and losses are generally capital gains or losses, but the tax treatment depends entirely on what you do with the option. Scenario 1. Buying and selling options. When you buy an option and sell it before expiration, it's a capital gain or loss. Held more than 1 year means long-term capital gain. Held less than 1 year means short-term capital gain. Example, you buy Apple calls for $500 in January and sell them for $1,200 in March. That's a $700 short-term capital gain, taxed at your ordinary income rate, potentially 22 to 37% for high earners. Scenario 2. Options expiring worthless. Long options expiring worthless means capital loss equal to premium paid. Short options expiring worthless means capital gain equal to premium collected. Scenario 3. Exercise and assignment. When you exercise a call, you're buying stock at the strike price. Your cost basis includes both the strike price and the option premium. Scenario 4. Assignment on short options. Assigned on a short call means selling stock at the strike price. Assigned on a short put means buying stock at the strike price. The premium collected adjusts your cost basis. Section 1256 contracts the hidden tax advantage. Here's a tax advantage many traders overlook. Section 1256 contracts receive special tax treatment that can save significant money. Qualifying Section 1256 contracts. Broad-based index options, SPX, NDX, RUT, VIX. Futures contracts. Options on futures. Certain foreign currency contracts, the 60-40 rule. Section 1256 contracts are automatically taxed. 60% long-term capital gains, 40% short-term capital gains, regardless of holding period. Example, $10,000 gain trading SPX options in the 32% tax bracket. Regular equity options, $3,200 taxes. Section 1256, $2,480 taxes. Tax savings, $720. Mark-to-market rules. Section 1256 positions are marked to market at year-end. Unrealized gains on December 31st are taxed as if closed. Strategic implications. Consider SPX instead of equity options for short-term trades. Be aware of year-end open positions. Use Section 1256 contracts intentionally. Wash sale rules and options. The wash sale rule is one of the most misunderstood areas of options taxation. Wash sale definition. If you sell a security at a loss and buy a substantially identical security within 30 days before or after, the loss is disallowed and added to the new position's cost basis. Options wash sale scenarios selling Apple calls at a loss, and buying the same strike and expiration means wash sale. Buying different strikes or expirations means generally not a wash sale. Selling stock at a loss and buying calls means generally not a wash sale. Example, January 15th, sell Apple calls at $2,000 loss. January 25th, buy substantially identical calls. Loss disallowed, added to new cost basis. Avoiding wash sales. Wait 31 days. Use different strikes or expirations. Use index options instead of single stocks. Use correlated but different securities. Keep detailed records. Brokers may miss complex cases. Tax-efficient option strategies. Strategy 1. Hold long options over 1 year. Leaps held longer than 1 year qualify for long-term capital gains. Strategy 2. Use index options for short-term trading. SPX, NDX, and other Section 1256 contracts benefit from 60/40 treatment. Strategy 3. Tax loss harvesting. Use options losses to offset gains. Up to $3,000 per year can offset ordinary income. Strategy 4. Qualified covered calls. Meet IRS requirements to avoid straddle rules. More than 30 days to expiration. Strike not deep in the money. Strategy 5. Retirement accounts. Active trading inside IRAs defers or eliminates taxes. IRA limitations. No naked selling. Record keeping and documentation. Track everything. Date and time, strike and expiration, premium, quantity, opening and closing trades, assignments and wash sales. Recommended tools. TradeLog, TurboTax Premier, Tax Act, or spreadsheets. Common tax mistakes. Mistakes to avoid. Ignoring assignment tax consequences. Triggering wash sales unknowingly. Poor record keeping. Failing to pay estimated quarterly taxes. Quarterly due dates. April 15th, June 15th, September 15th, and January 15th. Options taxation isn't just about compliance, it's about keeping more of what you earn. Using Section 1256 contracts, avoiding wash sales, keeping records, and planning ahead can save thousands each year. Don't let taxes drive your trades, but don't ignore them either. If this guide helped, hit like, subscribe, and comment with your biggest tax challenge or lesson learned.